In today's video, we are talking all things dividends. With the tax planning season well and truly underway, understanding how dividends work and what they are and how they can be used to manage your tax effectively is really important. From the beginning, dividends are the distribution of profit to shareholders. They are only paid by companies, and they can be paid by both privately held companies and publicly held companies like Wesfarmers, Commonwealth Bank or BHP. Privately held companies can pay a dividend at whatever point they like during the year, provided they have the profit and the cash. Publicly held companies tend to only pay dividends twice a year. And the reason for this is because they are required to have their accounts audited before they're allowed to declare a dividend. A dividend can be paid to a shareholder as either franked or unfranked. Franking credits, also known as imputation credits, are the portion of tax already paid on that dividend by the company. A fully franked dividend is one in which the entire amount of the tax paid on that dividend is passed on to the shareholder. A partially franked dividend is where only part of that tax is passed on to the shareholder. And an unfranked dividend is one where none of the tax is passed on to the shareholder. An unfranked dividend may be paid by a company where they've been able to use prior year losses to reduce their tax or accounting income to nil, but they still have a distributable amount of profit to pass on to shareholders. Whilst this concept of imputation credits is not unique to Australia, a shareholder's ability to derive a refund from the franking credits is unique to Australia. What I mean by this is, if you hold shares in a company and the imputation credits on those shares is greater than the total amount of tax that you need to pay for the year, then you will receive a refund for the excess amount of imputation credits in that year as a refund. So now we have the basics under our belt. Why are dividends so great from a wealth management strategy point of view? Well, first and foremost, they are a passive form of income, so they will increase your overall wealth without you having to do any additional work. As a small business owner, they can be used as a bonus to top up your overall income when you get to a point in the year when you know what your overall cash position is actually going to look like. The best way to demonstrate this is with an example, so let's look at a basic one to start with. Here's Bob. Bob owns shares in Physio Co. Proprietary Limited, the company he runs his physiotherapy practice from. Bob is married with 2 small children, and so he draws a basic salary of $120,000 from the business for the entire 2024 financial year, which covers the living expenses for him and his family. Towards the end of the financial year, Bob does some tax planning with his accountant and discovers he's made a $200,000 profit for the year in the business. The business has been paying quarterly installments for the year, which total $50,000 in taxes paid to the ATO. He wants to take his family on a holiday, but he also wants to leave some money in the business to pay for his growth plans over the next 12 months, including another employee. So his accountant suggests he pays himself a dividend of $50,000, leaving $150,000 in the business to fund his other growth plans. Because the company has been paying tax, he is able to pay a fully franked dividend to himself for the 2024 financial year. And this is how his tax works out. He has a salary of $120,000, a dividend of $50,000, bringing his total taxable income to $170,000. Tax on $170,000 works out to $40,625. He has franking credits of $16,667 from the dividend that he's paid himself, and the company has paid pay-as-you-go installments on his salary of $29,467. This means he's actually refundable of $5,509. Dividends can also be used as part of retirement planning, and no, I will not be giving any advice on superannuation funds today. However, many Australians do use dividends as a way to supplement their income when they retire. These primarily self-funded retirees use the imputation system to actually improve their cash flow. What they do is they receive the dividends when they're actually paid, usually twice a year, and then they do their tax return and they receive a refund for the franking credits as well. Let's look at another example. Meet Sylvia. Sylvia has now retired. However, when she was working, both her and her now deceased husband heavily invested in stocks, believing it was better to diversify their savings rather than keeping it all in one basket. The family home is debt-free, and between the interest on her savings and the dividends she receives, she lives quite comfortably. Whilst she is of pension age, she doesn't apply for a Centrelink pension. So she has interest income of $15,500, dividend income of $16,000, bringing her total taxable income to $31,500. Tax on $31,500 is $2,527. She has franking credits from her dividends of $6,857. She receives the low income tax offset of $700, and she receives part of the seniors and pensioners offset of $1,827. Her total refund is $6,857. So as a strategy in retirement, dividends can actually be quite effective. But what if you have somewhat more going on and you want to grow your overall wealth? Because as a private company, you are not restricted as to when you pay a dividend, you may be able to use dividends as a way to fund the purchase of assets throughout the year. Let's go back to Bob. As well as his plans for future growth, Bob also wants to build his wealth outside of the business. Part of his overall strategy is to invest in property, and as such, he purchases an investment property, which he intends to use as a holiday home, but also for short-term accommodation. It is intended that the property be negatively geared, and as such, he owns it in his own name rather than in his wife's name. In order to purchase the property, he requires a deposit, and he wants to draw that deposit from the business. Setting aside key tax planning issues for the purposes of this example, he is able to draw a fully franked dividend from the business to fund the deposit on the purchase of the property. Should he choose to do so, he can also take further dividends from the business to fund any improvements that are needed on the property to get it up and ready to go for holiday accommodation. More complicated structures can also benefit from the payment of dividends, as they can be used as a way of deferring the taxing point on income until a later point in time when it's not going to cause negative tax consequences. While we're touching on timing, the timing of the payment of dividends is important. As an individual recipient of a dividend, you are taxed on that dividend when you actually receive it. So, for example, Bob, if he were to pay his $50,000 in July 2024, the taxing point on that dividend would actually be June 2025. If he paid that dividend in June 2024, the taxing point for that dividend would also be June 2024. In terms of managing your overall wealth, this is a great advantage. It is possible for you to be able to receive the cash now and not actually have to pay the tax on that until a later point in time. Of course, it must be remembered that as a company, you don't actually have to pay a dividend at all. You can actually retain those funds within the business to use to actually achieve your overall strategy. Right, well, I think that's everything in terms of dividends. I haven't delved too much into more complicated structures. Suffice to say that the payment of dividends amongst larger groups is a really effective way of managing wealth. If you have a question, an idea, or a solution about dividends, then I would absolutely love to hear from you. Otherwise, I will leave you with this video to watch next, and I will catch you in the next one.